Mode.
Good afternoon. I'm Roy Weiler, the Director of Trading Operations for Time Leverage Capital. For anyone who has missed our previous webinars, please give us a call at 800-519-9085 and we can send the videos you missed. You can also browse by topic on the Option Ranger website under Demo Videos. If you're a guest but not yet part of the beta program, please schedule a brief discussion of your current trading knowledge so we can prepare a lesson plan based on your level, at your pace, and on your schedule. Now, for an important disclosure, please be aware that trading futures and options involves a substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Please be sure to read and understand all disclosures before investing. All of the examples discussed are for educational and illustrational purposes only. Our examples are not individualized trading advice. Each person must ultimately make decisions based on individual risk tolerance and financial objectives. If at any time during the webinar you have questions or trade ideas, please type them into the chat box and we will do our best to answer them. Our presenter today is Mr. Adrian Mueller. He's the lead developer of the Option Ranger software and served as chief strategist of Dow Jones Megatrends, an all markets newsletter. Mr. Mueller is the founder and principal of the independent introducing brokerage, Time Leverage Capital, and a former stock option principal. The program in which you are participating was developed over many years to train professional brokers and to provide user-friendly educational programs for individual investors. Without further delay, welcome to our Bull Call Spreads for Upside Moves with Undecided Volatility webinar. Mr. Mueller?
Thank you, Roy, and happy Tuesday afternoon to everybody. Today, we're going to go straight into our strategy gallery and go into our discussion. To summarize, in order to have a more complete or well-thought-out trading strategy, our gallery is laid out with two of the primary
Mr. Mueller?
necessary. Yes?
You're not sharing your screen.
Okay, that's okay. Okay, I am now showing my screen, I believe, so sorry about that. We're
Yes.
in the strategy gallery. And in order to develop an opinion, we try to have a complete outlook that covers at least two main points, and then beyond that we have to have further thought in trying to map out a trade. One of the objectives of the Option Ranger is to make one think in order to have the inputs that go into the trade, and during that thought process to determine whether or not the risks and rewards are worthwhile by looking at actual outputs on spreadsheets. On today's trade, again, we are looking at the two principal outlooks, which is one direction that most people are familiar. They have a bullish outlook, they have a bearish outlook, or a neutral or undecided outlook. The second, much less considered area, but an area that is essential, is to have an outlook on volatility as well. And that is, to what extent is the market moving? What is the standard deviation? How large are the anticipated moves? And on that basis, to come up with a volatility outlook. And very much like direction, volatility can go up. But as the image shows here, volatility means more up and down bouncing more than an upward directional outlook. We can have volatility go down, as when markets are very volatile and then they quiet down. That's another type of an outlook. And finally, an undecided or neutral volatility outlook. Today's trade for bull call spread is a bullish trade. It's clearly under the bullish trading strategy category, and it is one that anticipates an undecided volatility. Just a moment, and here we are. The other possibility in that particular scenario is a short butterfly spread, and we're going to cover that another time because it is a more complex combination trade. As you can see here, and we have a graphic of the image, you can always click on the graphic and now you're taken to a page with a trade detail. You're going to notice a new addition, thank you very much for the suggestion, to our beta group. You are more than earning your keep in the use of the software. As you can see here, in addition to a directional outlook and a graphic, we've incorporated a demo video of bull call spreads and when to use them that will take you to a former program with a demonstration, and we are accumulating a library of content, of demo video content, on how to input trades which you can visit in our reference material section under demo videos. Intuitively, however, they appear here. Now, of course, you can look at the demo on your own, see how the inputs are, see a former complete webinar and an increasing library of content, or just get a quick reminder by looking at the image. And again, as you can see here, the strategy consists of buying a call and writing a call. The profit is limited to the spread minus the costs, and you have the description here. What is the outlook? If you believe that the market is bullish, but moderately bullish, it will go up somewhat, it's more likely to rise than fall, and it will not significantly exceed the strike price where you collect premium on the short call. The profit is limited to the difference between the strike prices of the options. This type of a trade really enables somebody to think not just is the market going up, but to come up with an opinion, ideally, of how quickly does one person think that the market is going up, and furthermore, just how far up is it going. A well-informed trading decision should all these factors into account. Where's the market going? How quickly is it going? And more specifically, how far in the desired direction or anticipated direction is it going? The inputs in the option ranger software compel us to think about these things and model out different prices and different levels until we come up with something that either makes sense to us, or if we don't, then we just know the trade is not for us. The profit, as we indicate, is limited to the difference between the two strike prices of the options minus the costs. The loss is limited to the premium paid and the cost of the trade. And time decay in this particular case is a minus. So if time erodes and the market does not go up, then this trade would be damaged by time erosion, and you have to watch time decay very closely. This trade, however, will not be as significantly impacted as a straight-out call option, in which case there will be only time decay on the long option, which is a disadvantage, without some level of time decay on the short option, which would make up a portion of that time decay. So in this particular trade, time decay is still a minus, but it is, if you will, less of a minus because the anticipation is not for rising volatility. Now that we have identified the strategy, the bull call spread, we know our scenario. We think the market's going up, but it's not going to explode up. It's not going to fall up. It's just going to kind of creep up to a level that we're going to think about and predetermine. And now we're going to figure out, in the easiest way that can be, which is just to pull up some trades and see how some of these trades would look on a spreadsheet on intrinsic values at expiration. So in this particular case, we're going to go to our master combination calculator, and we have already saved, as you can see, some bull call spreads in 3 markets: in the S&P, in gold, and in crude oil. And all of these positions are on the June option. So let's go ahead and pull up the June S&P position. In this particular case, a person is buying the S&P 500 index at 1860, so looking for the market to be above 1860, and selling the 1960 call, meaning that there's a target of somewhere around 1960 is the ideal expiration. So this is a bullish trade. And let's look at the particulars. Now, we've already input the trade. As you know, once you put in the S&P 500 index, the contract market comes up with the tick values and the specifics and a helpful link that takes you to the S&P particulars and the what to watch section on the S&P. And we have a call spread, so our strategy has been defined and the boxes populate. The call spread consists of buying calls and writing calls. In this case, it's a 1-by-1 non-margin call spread. As long as you don't sell more calls than you buy, this is a non-margin trade. So today we'll be looking at non-margin trades. Be very mindful that if you write more calls than you bought, Those additional calls would be naked calls and would be subject to margin. So today we are going to strictly look at call spreads, vertical call spreads, bull call spreads that are one-on-one, no naked option, no margin. Let's have a look at the particulars of the trade. The S&P call at 1860, trades for 54 premium points. We multiply that by the size of the index, which is 250, and we see that there's an outlay of $13,500 in order to have the right, but not the obligation, to buy the S&P at 1860. In order to mitigate the costs and the volatility costs of being in that option, this person also sold a call at 1960, saying, I don't think this thing is going to 1960 or much above it. So this person would say, I want to be long, but let me reduce my costs by 2,500 because they think this market's not going to go to 1960 anyway. So why not reduce the cost of this 54 call by collecting 10? Then we look at the particulars of the trade. Now the person ends up with a net debit of 11,000 minus transaction costs that have already been input. So the net debit on the trade, put it in red, so that should be helpful, is 11,110. And that, as you can see, also in bright red, is the maximum risk of loss on the trade, which consists of the premium debit paid, in this case, along with the transaction costs. Now, however, and the maximum profit on this trade, as we can see, is 13,890, which is the difference between the two strike prices minus this cost. Intrinsically, and you should really keep this number in mind, although volatility and premium prices need to be monitored at all times, somebody who puts on this trade should have a sense that intrinsically, for the long option to be in the money at expiration, the market needs to be above 1904.44. So in this particular case, if the market's around 1870 or so now, in order to break even at expiration because of the premium paid, this market does need to work its way up about 35 points to be above 1904.44 based on these numbers. Or, as monitoring premium at all times, the premium break-even has to be above 44.44. And again, that's not exactly the tick value, so I would look at this and say 44.5 or 45. So you keep monitoring prices. If this premium is at 60 and you want to come out of the trade from 45 to 60, you picked up 15 points. So on that, the math would be, let's say somebody says, well, I picked up 15 points. And the tick value is 250. Let me just see if that's something that's interesting. So the person would say, well, I picked up 37.50 net on the trade. They might want to come out at that level. By the same token, if the premium goes down 15 ticks, then this trade would be down 37.50, and the person would have to decide, do I want to hold on or do I want to mitigate my losses and look for an exit. Let's keep looking at the specifics on the contract again. We have them listed here, the index values, the options unit, and then a grid that shows us the sweet spot on this trade. And it's pretty well defined. We know that if there's no adjustment, no offset, somebody just buys this spread and forgets it, then at expiration, if the market drops or is flat or doesn't get to where it needs to be, the purchaser of this bull call spread could lose the maximum possible in this amount, which is the initial debit of 11,110. I strongly recommend that no person should incur that maximum loss if they monitor the trade closely and look for exits if their objectives are not being met within a particular time frame and before time erosion really finishes off the long option. On the other hand, on the upside, as you can see, having collected that 2,500, sold that option that was sold here at, in this particular case, at a strike price of 1960. It really doesn't matter how much above 1960 this market goes, gets past 1960, doesn't matter. Gets to 1968, it's still the same gain. It's still the same gain at 2000 going up and up. No matter how much this number goes up to 2000 and beyond, the profit in this case is predetermined once the short strike price has been exceeded. So obviously somebody who looks at this trade is looking for a trending, moving, non-explosive market. Now, just for purposes of illustration, again, if somebody, let's say somebody looks at this trade and says, I want to be bullish, but I don't think this market has much of a chance of getting past 1960. That person might turn around and say, you know what, I want to collect more money and make money in a narrower range because I'm not that bullish. So let's say that person thought, let me see if this market could go, I only think it's going to get to 1930. So let's say somebody says, I think it's going to move up, but I think it's going to move up even less, and this is where practice and the inputting of numbers and changes is important. That person might say, you know what, let me go ahead and go to a strike price of 1930. And again, inputting strike prices is very easy. Once we click on the box, a dialog box appears that tells you how to input the strike price, and it takes you to a link with more information about strike prices. In our demo library, we also have a discussion of different types of options in, at, and out of the money options, and how they react. That has a direct impact on selecting the strike price. So in this case, we're still writing an out-of-the-money option at 1930, but closer to the money in order to collect more and anticipating a smaller upside move, but still an upside move. So what would that 1930 call be for that particular month?
It is trading at 19.
Okay, so as you can see now, although the upside potential has been reduced by 30 points, there's 9 extra points in premium collected, so we know that's 9 times 250. So that would be 2250, but instead of doing all that complicated math in our heads, let's just go ahead and hit calculate, and as you can see now, we immediately have a basis for comparing the next trade. Oh, and we have quite a few of them sitting here, and let's have a look at what we have now. And the particulars of the trade has changed. Now the person is still spending the same money on the 1860 call, but collecting 4750 on the 1930. So the net outlay on this particular transaction now is at 8750, and watch this, it's very easy to do. So I'm spending 8750, which is my maximum risk after cost, so calling 8860 total. That's my maximum risk. I have a chance at 30 points less, but wait a minute, how much was that other one? So then you can just go back to your save trade, click on it, and there it is. So as you can say, it's the difference between risking 11,110 on a particular trade versus risking, and again, we can save this under tab later so that we can see the trade. So I'm risking now, instead of 11,110, I'm risking 8860. So it's a lower risk. The break-even, as you can see on the future now, is down to 1895.44. Before we were over 1904. And again, we can just click back and forth to compare the profit and loss numbers and the break-evens. And the break-even premium now is at 35.44. So that's lower as well by about 9 points. And if you look very closely, the 9 points, extra points that we collected on the second option is what reduces our break-even by 9 points, both on the premium and on the futures. The numbers have to make sense. If they don't make sense, we don't belong in a trade. So let's have a look at this one. And as you see now, the risk is diminished. But again, the maximum risk is incurred if there's no offset, there's no exit strategy or money management strategy. On the other hand, on the upside, as you can see, the break-even at 1896 intrinsically, the trade makes a few dollars, whereas on the wider spread with more potential and more cost, intrinsically, this level would be a losing level at 1905, which is relatively close to the previous break even. Now this trade picks up 23.90, and then of course it does hit its sweet spot at 19.30. It's 86.40, and that is the maximum that can be made on that particular trade, regardless of how much the market goes beyond that point, because the call has been written at 19.30. And as you can expect with any objective measurement of an investment, as you can see, the cost in this trade is lower, the break-even on this trade is lower, and as you should expect in the real world, the profit potential is also somewhat lower. So there's definitely an efficiency in the marketplace, and what the option ranger does and what any good calculation does is enable you to see where your sweet spot is for this trade. In this particular case, as you know, it is at or above, it is above your maximum gain in this particular case at the 19.30 strike price that you wrote. If you're doing ratio spreads and you try other combinations, you can change the number of positions, you can change the combinations, recalculate, and view the trade on the saved tab to see how it does. One more reminder, be very mindful that if you input these trades here, you should look into signing up for your platform where you can input these trades, get them updated in real time so that you can have access to quotes and charts and monitor these positions in real time with real updates of value using one of our available platforms. So you will be able to tie this in and monitor positions as you go. Okay, unless there are any questions on the S&P, we're going to go ahead now and proceed with the next market, which we're going to be looking at the gold market. The gold market has rallied, believe it or not, over $100 in a reasonably short period of time, and today is correcting a little bit. We're seeing June gold at $1356.40, down $16.70. And let's look at our preset gold trade. Again, we're looking at a call spread. When you click on the gold market, the contract specifics come out. It's 100 troy ounces, so it's $10 is our tick. We have an input of how to put in the strike price with a link to further discussion of strike prices and different types of strike prices, as well as how to input a premium. In this particular case, again, this person is looking to buy gold, to have the right but not the obligation to buy gold at $13.60. So this is an at-the-money option. It's actually about $4, $3.50 out of the money, so it's a close to the money option for a premium of $39. And then this person says, yeah, I think gold is going up. I don't think it's going above $14.60. So again, they would want to reduce the costs. They don't think the volatility is going to go up. They think the market in this time frame is just going to march up slowly, trend up, but not explosively, or quietly. And for that kind of a trade, this would be the market, again, if the goal is at $14.60 or thereabouts. The math is quickly done on the trade. Again, we're talking about buying a gold call at $13.60. That's 39 premium points times 100 ounces is 3,900. So it's 39 times 100 ounces is 3,900 for the right but not the obligation to buy the gold at $13.60. And the same person, to mitigate their costs and also capping profit potential, decides to collect $10 times 100 ounces, collects $1,000 in order to reduce costs, along with capping profit, because this particular person would not believe that gold is going to make it beyond $14.60, which makes sense because if gold went up above $14.60 in that time frame, or they thought it would, then that would be a rising volatility expectation, and a rising volatility expectation along with a bullish position does not mean a bull call spread. A rising volatility expectation might mean purchasing a call or doing some other strategy that anticipates rising volatility. So now we're looking at a trade here. Cost $2,900 minus cost is $3,010. That is the net debit. And again, as long as no more calls are sold and purchased, the maximum risk is limited to the premium paid, the debit on the trade, and factoring in the transaction costs. So the break-even on the futures would mean that this market, by expiration intrinsically, would have to be above 1390.1. Somebody who doesn't see this market moving up nicely beyond 1390 at a fairly decent pace should be extremely cautious about putting on this trade in this particular configuration. On the other hand, on certain types of volatility and a move, the break-even on premium is 30.1. So again, you can always do the math because it's 100 ounces. So if it's up $10, let's say if the price goes from 30 to 40, that's $10 times 100 ounces. The net would be $1,000. If it was down 10 premium points, then it would be down $1,000. The difference being that the maximum loss is limited to the amount of the debit. That's why you pay a premium. And the maximum profit would also be limited to the difference between the two strike prices minus the premium and costs, which in this particular case is easily translated into $6,990. We have a review here, and let's see if this trade is in our sweet spot. Well, the sweet spot for this trade, as we said, is at the strike price that was written, which is 1460. So as you can see, once the market breaks above 1460, it doesn't really matter much. The maximum has already been gained on the trade. The maximum has already been gained on the trade, so if the market goes to 1600 or 2000 or 50,000 or any absurd number to the upside, the profit potential is limited because the premium collected gave the difference above that number to the person who purchased that option. And again, the maximum risk, as you can see, doesn't matter if gold goes to zero. If they give it away on the sidewalk, you can't lose more than what you spent on the option, on the spread rather, which is the premium debit and costs. Again, if your market doesn't go up within a certain time frame and you see time erosion being a negative on this trade, it would be extraordinarily ill-advised to sit and incur the maximum loss of 3,000 plus without some sort of an exit strategy, either based on a time or on a price or some other criteria to salvage premium if losing money, and also to offset if your outlook changes or you're making money. Again, on a trade like this, and I'm going to want to do another example for people that have a more tight outlook. So I'll be looking for a price, let's say on a 1420 call for somebody who is bullish but thinks the market is going to go up a little bit less. So let's say somebody goes in and says, you know what, this is kind of a lot of money to spend for me to have room all the way to 1460. I'm looking at this thing, I don't think it's going to 1460. I want my break even to be a little closer, and I want to spend less money. So let's say they turn around and say, well, you know, this range doesn't look right to me. I'd like my sweet spot to be a little bit lower in the price. They might turn around and say, well, let me see how a 1420 call is priced and how that affects my break even. So let's say on a 1420 June call, the price would be, just a moment. Again, when you're using our simulation platform, you'll be able to pull up these prices immediately and input them yourself.
It's at $16.
So that's at $16, which we know for a fact. The difference between 10 and 16 is 6. 6 times $100, which is the tick value, is 600. So all the numbers are going to change by 600, but you know what? We don't want to rack our brains with that. Let's just go ahead and let the computer do the work. All the numbers change. Now, although we still paid the 3,900, collecting 1,600, that's 600 more. Now the trade is at 2,300 instead of over 3,000. 2410, including the cost, is factored in. The break even is lower now. It's at 1384 rather than 1390. That's our $6. The break even premium is also lower by that familiar $6 at 24 and change. So there's less spent, there's less risk. You should still look for an exit strategy if the market doesn't go your way. But as you can see, our break-evens are closer in. At 1392, this particular trade would be making money instead of losing money a little bit. and then on it goes until we get to our maximum, which in this case is 35.90. So again, the cost is less, the break-even is closer because we collected more premium for an out-of-the-money option, and so the risk and reward scenario continues to be balanced based on what can be made and what can be lost in the gold trade. And again, just to look at one other example, let's say somebody is more bullish gold, and they say, you know what, I want to sell a 14, forget that, I want to sell a 1480 call. They want even more room. So now as a person says, you know what, I want to make more because I think that this market's going to go up even more. Let me see if it's worth my while to sell a 1480 call. How much is that worth?
$7.
That's $7, which we know 7 times 100 is 700. But nonetheless, let's go ahead and do the math. Now we see now this person is spending even more. The highest of the trading 900, only collecting 732 with fees, 33.10. But because this person is doing a wider spread, they're risking more on a flat market or drop, outlaying more, have a bigger profit potential on a move, and need a higher level break even because they collected less money. So as you can see, there's a way here of monitoring and selecting your positions, selecting your strike prices, and deciding whether the premium that you collect against your anticipation of diminishing volatility reduces your cost enough to be worthwhile to cap your trade. Remember, when you collect this premium, you are capping your position in exchange for lowering your initial cost. Finally, let's go ahead and look at a third market that has been stirring and has had a lot of geopolitical excitement associated with it. And by that I'm referring, we already have a preset trade in the crude market. I want to remind you that while we can preset these trades in a tab and you can change them as I'm doing in this meeting, you can easily input your own trades from scratch using our demo videos and tutorials and on any market, and you can see that we cover pretty much all markets when you look at the drop-down menu. And in this final case, we are going to look at the crude oil market, and we have a preset tab there. Again, a crude oil spread. This person is purchasing a call at 98, which means they have the right but not the obligation to buy crude oil at 98, and they're paying $2.90 in premium. Again, we know up here that that's a 1,000-barrel contract, so if you take 290 and you multiply it by 1,000, sure enough, you get 2,900. The math is all done in there as a shortcut, but we want people to also see where the math and calculations are coming from for a more intimate understanding of the pieces of the trade. Finally, this person is anticipating that this market can go up, but they don't expect it to go up with hugely explosive volatility. So they're saying, you know what, I'm going to go ahead, and I think this market's not going much above 106. So let me see what I can collect to reduce my cost in this trade, because anything beyond that is unlikely, so why not get paid a little bit if the market's not going to go past there anyway, in my opinion. So on that type of a scenario, this person would collect 50.50 times 1,000 barrels. That's $500. So they would pay $2,900 for the option that is bought for the right to buy crude at 98. They would sell an option for $500 to relinquish the right to that position at 106 for a debit, an initial debit of $2,400. Again, you factor in fees. If you use a default of 55, that's 2 positions, for a total net premium and cost debit and maximum risk of 25.10. Again, as you can see, what all these trades have in common, the reason we like to demonstrate them together is because their risk and profit features are the same. The maximum risk is always the net debit on the trade. The maximum profit is the difference between the strike prices minus the debit. And then, because we're not trying to get back to high school math, We have calculated the futures break even. This person would have to look for basically crude to find its way somehow above $100.50. Of course, that's not a full picture depending on volatility, but it's a good way to try to see if you think the futures price is going to be beyond there by expiration, maybe sooner. Again, the premium break-even point, which you monitor at all times, is 2.51 or 2.50. So at any given time during the trade, you monitor the premium and decide, is it a trade which I want to exit for profits? Is it a trade that I should be offsetting because it's not going my way and I'm losing? What exactly is the scenario? So you keep monitoring the premium at all times, and also being mindful that your real expectation is that this market's going to find its way above 100 somehow and as close to 106 as possible. And then when we look at these risk and reward scenarios, again, we see one of the features of these non-margin trades that people like is that if the direction is wrong and the market tanks badly through the floor, the maximum risk is predetermined. Again, just because this is the maximum risk, I can't caution you strongly enough that one should not sit on their hands and incur the maximum theoretical loss on a trade. If you're monitoring your position and the market's not confirming your bullish outlook or your volatility outlook, you don't need to sit around and be stubborn. You can say, let's say if your maximum risk was 25.10, your position, you get a bid and ask or a quote, you think it's going to be 1,500 and you've changed your mind, you can walk away and mitigate your losses to whatever the market has available at that time in premium for your positions. And of course, if you wait or circumstances it's late enough in the game or the market drops enough, then one would not be able to collect anything significant. So be mindful of managing this number, because if you mitigate your losses on the when you're wrong, as you can see, the profit potential is pretty good as long as you don't incur the maximum loss every time that you're wrong. And so as you can see here again in the trade, we have a limited risk and the profit potential is also capped. So once we break above that 106 level, which is a sweet spot on the trade at 54.90, doesn't matter how high the market goes, that potential is capped because we gave the right to those additional gains to this person that bought that $500 call from us. On the other hand, they reduced our cost and gave us a lower sweet spot in this particular scenario for the person to make money. Again, when you're looking at this trade, you can change the strike prices, you can change the number of positions, you can change the premium amounts to fall more in line with your outlook. And again, as you will see, the option ranger, the spread calculator, master calculator have the features of easily changing these trades into ratio trades. So I'm just going to show this, and I'm going to erase it because you'll see the minute you sell an additional option or an additional call. So I'm going to change this scenario to a 1/2. Now there's an extra call sold. As I indicated to you before, if there's an extra call sold, that becomes a margin trade. So although now the cost is just down to 1,900 instead of 2,400, etc., plus fees, now it's 2,065. The break-even scenario changes, but the important thing I wanted to point out is that the risk scenario on a very large upside move, because of the second naked option, becomes unlimited and is labeled accordingly. So for people that are not in a position to take that risk, if the market breaks out above 111, call it 112, as you can see here, now the sweet spot looks different. The sweet spot's in the middle. The break-even is lower. The potential for profit is higher at lower numbers. On a drop, the risk is limited as before. So you could say that the risk is limited on a drop because you bought a call, but due to the second naked call on top, the losses can increase as that second position could be losing tick for tick on a significant rally. So I wanted to just point that out to you, although it's outside of the parameters of this particular trade. For those of you that are inputting trades, you can input in those trades, but make sure that you're aware of the margin difference. And if you are unsure, then you have to go back and actually look at the risk and reward table and see whether the risk is limited or whether the risk is unlimited, because it's going to be labeled accordingly along with your break-evens on premium and on intrinsic value on the futures. We will be doing some follow-up strategies in the future. A lot of people are asking, well, if I do a spread, I do a call spread. Let's say, for instance, they do a call spread, or let's use the S&P. Let's say they do an S&P spread, and they actually end up doing it or modeling it an account. And they say, well, what do I do if my outlook changes? What if I would go back into the strategy gallery at this moment and I no longer have the outlook for a bull spread? Now I think that the market is no longer bullish. I think I'm undecided, but I think the volatility is going to go up. Well, all of a sudden, we've got a whole different outlook. How does that affect the trade that is in play? What we have started out as a beta group strategy follow-up is now going to become a very regular feature in terms of following up those trades. And let's say, for instance, if the outlook changed, perhaps this market has found its way to, let me just say, at some point, let's say this market has found its way to 1930 in a hurry, and our volatility outlook has changed. We have to put this trade back in, and we have to look at follow-up scenarios and the changes that would be called for in the middle of the trade, because while this is a good way to start and model out a trade, as we all know, putting on a trade is just like getting in your car and starting out on a ride. You may be pointing in the right direction, but if things change, you have to know how to steer and how to get to your destination as things change. So we are going to incorporate follow-up strategies and responding to follow-up strategies in the same format, using the basics of direction and volatility as they change to modulate the trades that we have. So we might turn around and take an existing trade like this and tell somebody, okay, you know what we're going to do now? If the volatility outlook is changing, we'll add another spread. Or perhaps we're going to turn it into a ratio spread. Or perhaps add some additional premium through another strategy, and we'll be able to map those out and model those out as well to monitor trades. Do we have any questions?
Actually, related to what you were saying, some people are interested in the spreads that we did a couple of weeks ago.
You mean the call spreads?
Yes.
Okay, let me just have a look here. Okay, we did those. We didn't save them here because we're really not trying to treat these trades as recommendations. They're really illustrations. So we did an example. I think it was in the future spread calculator. Here they are. And we actually labeled them at that time no margin, just to make the point. So let's see what we had. We had, actually these were, it's exactly a month ago, February 18th. And let's see, maybe we can update some of these values. We've got, we had a call spread for June, buying the 1820 at 63 and selling the 1920 at 17. So these were the particulars of the trade. Doesn't look that different from actually the trade that we did today in terms of premium. One of the examples we did and premium spent. And as you can see here, the sweet spot for this trade intrinsically is 1868. The market's already broken that. It's around 1870. So this trade is already making, you can do the math from 68 to, from where we are to 70. Let me see, if we're at 70 and the market's not closed, call it 71. Our futures break-even point would be 1866.5. So if you go to 71.5, I'm just making up numbers here for illustration purposes, that would be 5 points. Intrinsically, you're looking at 5 times 250 would be 1250 if it was expiration. However, what we would do in this case and see if the trade worked out would be probably to look at the premium values. And in this particular case, our break-even on premium would be somewhere, let's say, at 46.5, and obviously we would be monitoring that premium now to see, depending on our outlook, whether it was worthwhile to take a profit on that trade or not. And again, if you were to look at those values, and we are looking at the June options, Roy, can you give us a ballpark spread price on that? And again, this is just for illustration purposes, so people can see how this thing moved in the last month with volatility.
As of this morning, the spread was worth about 54 points.
Okay, so if it was worth 54 points, and let's say one did it for 46.5, and it goes to 54, so let's call it 47 to 54. We're going to round up a little bit, so the math is easy. So that would be 7 ticks times 250, and 7 times 250, we can do the math, or we can do it's 2250.
$1,750.
1750, excuse me. So that would be 1750, assuming those fills. Again, we didn't show these trades as a recommendation. We're not trying to take credit for this trade. It was an illustration. And I think at the same time, or in that same time frame, when we did a bear put spreads webinar, we might have done that same example in reverse. I think we have the same example in this particular case on the using some different strike prices. In this case, we raised the strike price from 1820 to 1850. So that was looking for that was a lower cost, a more bullish outlook. And we can look at the premium, or we can just look intrinsically where the market is. Again, as you can see on a different trade, intrinsically, this one was at 1878.44. So if today was expiration date, that trade, which cost less money, but purchased an option farther out of the money, would still be fighting to get to its break-even point on the futures. Although again, on premium, it might be getting somewhere on the premium. Do you have the premium calculation for that, just out of curiosity?
As of this morning, it was about 34 points.
Okay, so we're looking at 34 points, and it was, call it 28.5 to 34. Again, because of the volatility in this particular case, although intrinsically the position is not there yet, but at 34 points, let's say we picked up 5.5. Boy, 5 points is 1250. So this trade, which actually spent less money and bought a long option farther out of the money, due to volatility, and because the market has been kind of marching up at a given pace, the volatility and the premiums are enough. Somebody said, you know what, I'll take that 1250 or whatever the number is, because you know what, I'm still not past 1880, and time erosion could be a factor. I'm a little less bullish. Person could choose to walk away just to collect that premium, or continue to hang in there. So again, that's an example, and let's see what else was there. We're looking. Oh my goodness, what's this? A soybean example. Oh my goodness, 1320 to 1420. I wish this wasn't okay. Let's have a look here again. In this particular scenario, all the particulars, including the contract specs. Hold on a second. Let me make sure that we get in the soybean trade. I didn't click it. Correct. So I have to make sure I click it extra enthusiastically so that the calculation occurs. And let me see at the top. Okay, now the change has been made. The tick value now and the contract specs of 5,000 bushels are showing the particulars of the trade. In this particular case, we have the debit on the trade. The futures break-even was 1358.20, and July beans are 1395. So in theory, if today was expiration, and it's not, so we'll have to look at premiums, this trade would be up over $1,700, and we can do the particular math over here by using the tick values. And on premium, because the trade, including costs and everything else being factored in, was 38.2 points. Now it's pretty intrinsic. Volatility has been going up, so let's see if this spread still performed. Go ahead. Can we get a premium for? Yeah, go ahead.
Today's settlement was 54.5 cents.
Okay, so you call it 54 and call it 54 minus 38. So here we go. Yeah, let's have a handy calculator. So you have 54 minus
You have 16 cents.
is 16 cents times, and this is $50 a penny, so 16 times 50 is $800. So this trade at an initial debit, total debit including costs of 19.10, would be up 800, and that's again because it's 16 cents times, and we have the tick value as 50. You can see that up here, the tick value, and then if you go up to the calculator again, that gives us a net after costs, assuming that fill, more or less of about 800. So again, a person would have to decide, this trade is in the money. Do I think it's going to rally? On a percentage basis, that's 1,900 to make 800 on that, and since in 1 month is fairly extraordinary, again, a person would have to decide, do I want to take profits here? Do I want to let it ride? Or do I want to perhaps modulate my position? A bullish person might want to roll up their 1420 call. A bearish person might want to sell their 1320 and play out the 1420. At that point, it would be a naked margin position. So whatever the scenario is, as the move evolves, we continue to change our outlook. We go back to our strategy gallery. We find our shifting position, and then through follow-up and fine-tuning that position, we can go back and adjust that position accordingly, re-enter it, and then of course track it on your simulation platform. And certainly if you're trading it in real time, you'll be tracking it very closely on your real-time platform. Okay, do we have any other questions?
No, that looks like about it.
Okay, please answer the survey at the end if you think that you got any better understanding, and if you have any questions on bull call spreads or any other type of trade, please be sure to let us know and continue looking for the changes. We're very pleased in the new layout on our demo videos, as well as within our strategy gallery, where now you're going to be taken in all of these scenarios to additional demo videos, both on how to input trades and also with a discussion of different types of trades and scenarios. The more examples you see, the more numbers run across in front of you, the better your grasp and understanding of the market. So continue doing what you're doing, and thank you all very much for your feedback that has helped us make the progress we've made so far. Good luck learning, and in case you are trading, good luck trading, and good luck overall. Take care, and I hope to see you tomorrow for our follow-up. And Thursday, we're going to be doing the opposite of this trade, same scenario. We're going to be doing the bear put spread, which as you can see is a corollary to the bull call spread, has a very similar outlook, except the expectation is for a bearish market, for a dropping market with undecided or flat volatility. I look forward to speaking with you on Thursday, and be sure to keep your questions and suggestions coming in.
Thank you.